It's a real pleasure for me to be here back at Stanford and to be present at this third annual State of the West Symposium. I find it, when I was invited, I found it difficult to give such a detailed regional focus to my presentation, because we central bankers do not make or at least in principle, we should not make a distinction between regions within one's country. So I will speak more generally. Certainly I will concentrate on the interaction between Mexico, Canada, and the US, and under the assumption that if we do things right on certain directions, for sure that will benefit the West US, West Canada, and Mexico. And certainly I recognize that Western North America has a huge potential and deserves a special attention. So that's why I am very, very satisfied with and very happy with the initiative that you are undertaking here at Stanford to promote the West. Let me start by saying what I would like to focus on in this presentation. The basic point I want to make is how can we make in today's economy North America in general a far stronger and more attractive region. For the last 10, 15 years at least, regional developments at the world level have become more and more important. Certainly you have seen the consolidation of Europe. You have seen in Asia a major effort to form certain regions to generate different type of agreements to support among each other. You have seen major efforts in South America and sometimes integrating Mexico with South America. Many South Americans do not like Mexico, and sometimes it's mutual, especially when it comes to soccer. But I think that this trend will continue. And we're at a point in the world where I think it's important to renew this view of regional strength, especially also because we have now a lot to learn out of the experiments that have been going out there, in particular in Europe. So I think that, if we look at North America, I think that for the last 20 years or so, we have seen very promising developments. Certainly one is NAFTA, and I'm glad that you will devote a session to discuss this. And I think NAFTA has had far-reaching consequences. I think it's also very important the developments and the promises that are out there in terms of energy. And again, I'm also very happy that it's an issue that you will dwell with later today. But the point I want to make is that I think it's important to see what the promises are in terms of macroeconomic strength. I mean, what I think we have been looking for the last at least 6 or 7 years is that macroeconomics really matter, that macroeconomic strength is essential. And probably we don't pay enough attention to it for many years, because basically we thought we had gotten it right. But the crisis in 2007 that basically triggered the financial crisis here in the US, and I think to a large extent still is ongoing, tell us that we still have a lot of things in the macro financial world. And I think it would be interesting to see how three countries can work together in these areas to end up in a much stronger region from a macro financial point of view. And my point is that this would build on top of the strengths that we have developed in trade, that we might develop in energy, and that hopefully in the future we might develop in other areas, like, for example, in labor. So let me go back for a few years, 20 years or so, and thinking what usually dominates many of these discussions about North America, and that is NAFTA, and that the fact that NAFTA had a big impact on the development of the region. And my first claim would to say that NAFTA was very, very good, but I think that NAFTA wouldn't have had the impact it had if through time in those 20 years, at least there wouldn't have been a major effort done by Mexico to converge to the US from a macroeconomic point of view. I mean, let's go back to 20 years ago. In 93, NAFTA was signed. The central bank got its autonomy. But in 94, we had in Mexico a tremendous financial crisis. It was a huge crisis. It costed us 18% of GDP. It inhabilitated our financial system for around 10 years. Pretty much 95% of our financial institutions disappeared or changed owners. Based on NAFTA, we managed to attract many foreign investment, and therefore 70% of the banking system now is foreign owned. But I think that this crisis, I think that really taught the lesson, because this was not a once-in-a-lifetime crisis as it happened here in the US in 2008. I mean, your previous major crisis was in the 20s. In our case, we have had consecutive crises in the 70s, 80s, and then 90s. So it was time to stop. And the government, through different administrations, I think have built up through this requirement. And I think at least in an unconscious way, because I mean, I haven't heard any single president, let's do this macro policy because we want to be similar to the US or Canada. But I think that there is certainly an underlying feeling that Mexico should identify itself, at least from a credit risk point of view, as North American risk. And what we should do, I mean, we will always be North Americans, and we always will be Latin Americans. But I think that from the point of view of how are you conceptualized in the markets, the sort of a asset class that we would like to be is to be North American risk. And I think we have been working towards that direction. But the other very important point is that this is not only a Mexico story. I mean, this is not only Mexico trying to improve its macro stance, because 20 years ago when NAFTA started, we were really the worst performers. But nowadays, certainly in many fields, Mexico is better off than the US, and in some fields than Canada. So I think this is a good opportunity this year, 2013, for all these three countries to make a major effort and distinguish themselves as a real strong, consolidated region from a macroeconomic point of view. And why this is the correct time? Because I think that what we need to do is not far away of what is achievable. Again, going to the case of Mexico, I think that we have done a very hard pushing since our crisis in '94. In '94, we had this, again, tremendous crisis. We had inflation rates of over 100%. We had huge fiscal deficits. We barely had access to financing in the markets. Now, all of that is behind us. And we have done it again by self-conviction, by the different governments understanding the importance of having a strong macroeconomy. And I would say that there are at least 4 aspects that you have to look into. That is fiscal discipline, monetary discipline, financial stability, and balance of payment sustainability. And there is always interactions among all these. And probably the way of doing it is also to be building the institutions that support all of this. And to a large extent, the institutions have been built. In the case of Mexico, for monetary policy, we have an autonomous central bank. For fiscal policy, at the end of the day, is the interaction between the executive power and Congress, but we have a very strong and recently reinforced fiscal sustainability law that establishes strong parameters to assure that the debt broadly described is sustainable. And for that, even this year and next year, the Mexican government doing some counter-cyclical fiscal policies, the debt to GDP level will, in the worst of cases, be slightly above 40%, and it's very likely that at the end of the present Peña administration should be below 40% of GDP. If you compare this to where the U.S. is or where Canada is, we are very, there is a big difference. No? Then there is also the situation of the strength of the financial system. I think that Canada and Mexico, we have fared much better, but all the 3 countries have been early adopters of much stronger regulatory and supervisory standards. And we can debate if this standard is good or is too strong or is too weak or is inconvenient. But overall, I think that the package is an adequate package. So in terms of convergence there, we are not that far away. And then the issue of balance of payment sustainability, I think, and this is a point I want to stress also in the next minutes, is that what has worked extremely well for the region is to have a system of flexible exchange rate, a system of flexible exchange rates. I think that both Mexico and the U.S., Mexico and Canada face external shocks that are very different from the ones that the U.S. faces. And of course, some of the external shocks we face come from the U.S. And if we didn't have the exchange rate to adjust, we would be in a very difficult situation. So I would say that if we concentrate in fortifying these 4 aspects at the regional level, we would have an outstanding region, because we would have the microeconomic incentives pretty much aligned in many aspects. For example, through NAFTA, There are other aspects that we need to work through. But then if we also establish a very strong foundation from a macroeconomic point of view, and there really is a push towards getting there, first that would eliminate many uncertainties, macro uncertainties in the region in itself. And the main component to promote investment is to diminish uncertainties. And if we diminish many of these macroeconomic uncertainties, I think investment would flourish, and I think that would be very, very promising. And I think also from the point of view of distinguishing the region from a macro point of view would also be very powerful, because right now what is really scarce is to have strong macro financial regions. And there is also, I would say, there is also the issue, the issue that strong macroeconomic macro foundations is an essential condition to enhance our potential GDP growth. And if pretty much all the countries in the world will embark in structural reforms to enhance their potential GDP growth, to have that strong foundation is of the essence. So the question is how to go about and do this, what I'm proposing. I mean, I think that the purpose by itself is an attractive one, but then how are you going to do it? And I think there are two ways of doing it. And I think this discussion might be interesting to you, because at least for me it was interesting intellectually. One is to go the European way. It sounds like a dumb idea, and the conclusion is really a dumb idea, but I think it's worthwhile to go through the exercise. I mean, what did Europe do? Well, Europe, for the reasons very different of what are prevailing here in North America, decided that it was important from them to pass from a trade union or from a free trade zone to a currency union. And you know, we are in a situation where that question might be interesting. And I remember, and this was 20 years ago, I was still at the bank, when NAFTA was being discussed, there was an incipient discussion about moving in this direction. And that was to do the trade-free zone, to do NAFTA, and then to move to a currency union. But that idea didn't last long. I mean, it was killed immediately, and it was killed immediately because both Canada, for two reasons. One, Canada and the US immediately said, Mexico is a very big risk fiscally and from the strength of its banking system. And the other is Canada said, I cannot live without a floating exchange rate when most of my trade is with the US. And I need the exchange rate as an adjustment mechanism. So the discussion was immediately killed then. Some of you might have heard that some people even thought about the name of the currency, and it would have been called the Amero, which is an awful, it's an awful name. But you know, there was this intellectual debate. Now, when the euro started, what was the first step? The first step was to establish the Maastricht Agreement. And the Maastricht Agreement was in 1992, I think. And what they did is they established some macroeconomic objectives for the countries to converge, and that would make the currency union sustainable. And in a way would pre-establish the macroeconomic conditions for to be as close as possible from a situation where the monetary policy for the region as a whole would be at the same time the best possible monetary policy for each single country. Now, what we know is that the euro was launched and the Maastricht Agreement was forgotten. The convergence in all these fields, for practical reasons, didn't take place. And the worst fears of those who designed or who thought about the currency union materialized, which is, well, central banks usually play a role of lender of last resort when you have a financial crisis and when you have a fiscal crisis. And politically, that is acceptable, not nice, but is at least acceptable if it's your own country. But it really is not very acceptable if you're using taxpayers' money to bail out somebody in another country. And a lot of the European discussion right now, today, is around this aspect. And what have the Europeans done? The Europeans have said, well, we're not pulling back, we're going all the way, and now we're moving from a currency union to a banking union, and eventually to a fiscal union. Of course, in the way, there is a lot of sovereignty that is being sacrificed, that this is demanding a lot from politicians, that's demanding a lot from society. You need to have a very progressive mentality of Europe, of being a European. You need to adopt that identity. And of course, regional interests and regional idiosyncrasies, as time passes, become more and more important. So we haven't seen really the end of the European story. That tells you that the euro by itself was not a success. I mean, the euro idea worked very well for a few years. It certainly benefited many of the peripheral countries because countries with very high interest rates suddenly were obtaining financing as if they were Germany, but the problem is that they were not Germans. And at the end of the day, the markets figured it out, and there was a run against some of these countries, and that's why Europe entered into such a big strain. So, in a way, what Europe did was to put the carriage in front of the horse. So what is important is to put the horse in front. And so if we would think from a North American point of view, before thinking of a currency union, we would have to really make strict that the Maastricht Agreement that, could be a place in the West, we could choose a nice place to do this type of agreement, and then make sure that we all comply with. But then there is the issue if that really would be the best composition for all of us. And again, here I come back to the issue of the exchange rate. And let's also make the following exercise. Let's suppose that we were under the Amero, that we had the US crisis. So what would have that implied for Canada and Mexico? It pretty much would have implied that the nominal and real exchange rate depreciation that took place in the Canadian dollar and in the Mexican peso that helped us, in a way, absorb that shock would have taken place through what is going on today in Spain, in Portugal, in Greece, which is by internal depreciation. And what is internal depreciation or internal devaluation? Is that you become more competitive by reducing nominal wages and by reducing nominal benefits to society. And that, of course, it's very, 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 very hard to achieve. And that's why you see situations like in Spain, where now they have unemployment rates of 27%, in Greece of 20-something%, in Portugal the same. In our case, we got the work done in a very efficient way, precisely because of the flexibility of our exchange rates that were anchored by strong macro fundamentals, both in Mexico and in Canada. The nominal exchange rate depreciated, we didn't get inflation, and that smoothed the adjustment mechanism. So, for sure, something that would not have been expected at the outset if you create a currency union, which is that the leader would enter into a crisis, would have had a tremendously a dangerous effect to the other countries. So what I would say is that, you know, we shouldn't follow the European way. It's not a good idea. So what needs to be done? At the end of the day, the list I came up with is not very different from what each country has to do to maximize its own potential. I mean, in the case of the US, we need a credible fiscal consolidation in the middle and long term. We need a skilled, careful unwinding of the unconventional monetary policies you have in place. And those two mostly to beef up confidence, to promote investment, and to increase potential growth. For sure, that would help Mexico, and that would help Canada, and that would help the potential growth in the US. In terms of Canada, I mean, Canada, it's a very well-run economy, and I think the only thing in the margin I would think is they need to be more watchful about the asset price inflation they're having, especially in housing, and probably to speed up a little bit fiscal consolidation towards the medium and long term. In Mexico, from the fiscal point of view, we need to continue reducing the dependency on oil income, which basically means that we need to increase other sources of tax income. We will have to deal with the spillover effects of the unconventional monetary policies followed by the US. And we need to catch up in making our economies more more competitive. We need to speed up our structural reforms, not only to move closer to the frontier of the transformation curve, but really also to expand potential growth. If we do all of these things, we should be able to enhance investment in the region, lower transaction costs. With the free trade agreement that we have, I think we would speed up the convergence in terms of GDP per capita, which at the end of the day is one of the objectives. And I think that we would also be in a much better position to further our integration in other directions that also would be very, very powerful. And I would say that the next step would be to work on labor mobility. No? So my remark at the end of the day can be summarized as it would be worthwhile for the region to articulate a joint policy that I don't think would be very, very different from what each country has to do to improve its own situation, to be able to generate a very strong region characterized by very strong macro fundamentals. And as we always say, to have growth, you need a necessary but not sufficient condition is to have strong macro fundamentals. And today, there is scarcity around the world of regions with these characteristics. So I finish here. Thank you very much.
That was great, thank you. In a minute, we'll open up to questions, but I wanted to take the opportunity of starting. First, I like the idea that this is seen as in NAFTA, not a zero-sum game, that everybody grows and we can all benefit from the other regions growing. I think the integration of the regions is important. And I wanted to follow up, sort of, you talked about Mexico dealing with the unconventional monetary policy in the United States. And I wondered if you could expand on that a little bit and talk about what your reactions are and how has that forced your hand in some ways or not forced your hand in other ways, and what you think about that.
Well, I mean, first of all, let me say that I think given the severity of the crisis and given the potential of financial instability around the world, some form of unconventional monetary policy was called for. So if you say to me, would you have preferred a situation without unconventional monetary policies, I would say no, because I think we would have had a far more difficult time. Now, I think that the territory of unconventional monetary policies is an unexplored territory, especially once you have to think how you will have to unwind them. And what we have dealt with in Mexico is a situation, I think it's three different phenomena. One, observing very high capital inflows. Second, capital outflows. And third, a lot of volatility. So you have to be prepared for the times where you are seeing capital inflows. There, different emerging markets have responded in different ways. Many of them have put capital controls, have put controls on credit intermediation. We ourselves are more in the camp that those so-called macroprudential policies can be very distortionary and can be the introduction of protectionist measures through the back door. So we have been more of the camp where to let as much as possible to let the price adjustment to take place. When the appreciation is too big, to introduce some rules, a rules-based system to accumulate more international reserves. But if you don't allow price adjustments to take place, the incentives for capital flows to continue are there. Now, if you have a too strong exchange rate, it also can have real effects, and that's why at some point you need to put some gravel on the floor, and the way we have done it is by precisely accumulated reserves. Now, you have to be prepared also for the time when capitals can flow out. And at the end of the day, that addresses the issue of how to deal with the compression of spreads that have taken place in emerging market debt. If you do an analysis, you can see that a lot of that compression is determined mostly by foreign factors. So you have to engineer domestic factors to compensate with the decompression that will come once the unwinding of policies take place. And that's why I'm very happy that in Mexico we're doing a lot of structural reforms. And I think that can affect the spread, that should affect the spread in a way that should benefit us. At the end of the day, if the unwinding is such that capital outflows are present, at the end of the day, we might have to use some of our reserves. And also, I think we have been one of the few countries that have made use of a facility that is provided by the IMF called the flexible credit line, which is to make contingent financing available for countries that are good performers. And we have done that. We contracted that flexible credit line. It has been good because it's a signaling that the fund thinks that our policies is adequate, and that gives us access to $75 billion, no question asked. So we have been preparing ourselves for that situation. But again, most of the adjustment, I think, will need to take place to the market. Tinkering too much is difficult. And of course, what would be also adequate is for the U.S. to take into account the spillover effects that their policies might bring to other countries.
Great. All right. Open it up to the audience for questions. Tom, you want to wait for a microphone? I think one's coming up here. You might say who you are as well.
Tom Stevenson, a member of the CEPR board here, a career venture capitalist and diplomat for a while with the State Department. We read a lot about privatization efforts going on, particularly in natural resources. And I'm wondering if you would comment a bit about how you see particularly the oil and gas industry. A lot of political resistance to opening that up more. How do you see this unfolding, and what do you think the economic consequences will be for Mexico and for North America?
Well, I mean, my own personal opinion is that the government is taking an important step forward, proposing legislation where the participation of foreign investment in Mexico is allowed under much stronger incentives than in the past. I wouldn't say it's a privatization because the assets of the state will remain in the hands of the state. So I think it would affect the industry in the margin in the way forward. But I think that this move certainly is derived out of the perception, the very clear perception that the government by itself cannot develop and cannot manage all the oil industry by itself. It's tremendously ineffective, and in a way it's tremendously costly for the Mexican society, because at the end of the day, you are limiting the development of certain sectors to the financial and managerial capacity of the government. And I don't think that's appropriate, and I think that the Mexican society has understood that, and I'm hopeful that the reform will pass. It will not be a home run, but I think it will be hopefully a good enough play that it will catch the attention of many people, and that it certainly will help Mexico in developing a very promising field that is underdeveloped, and that it can really enhance our potential rate of growth.
Great. Question? So, pitch? Hang on.
What part of the GNP of Mexico, I know it's unmeasurable in specific terms, is in the drug trade, all the famous illegal activities in Mexico? Not that we don't have them ourselves, but what part of the economy would you say is related to that in a percentage? And is it shrinking? Is it staying about the same? And what is the impact of that activity on the growth of Mexico economically?
Well, that question has many dimensions. I think the one is the aspect of informality, the other is the aspect of illegality, and the other is the side effects. The informal sector in Mexico is large, and by this I mean the development of vendors on the streets and otherwise legal activities, but they're not formal. And that's a challenge that the fiscal authority face, the regulatory authority face, and that's an area where we need to move forward and improve substantially the economy. And there basically what it means is there needs to be much better combination or coordination between federal, state, and municipal authorities. There are different numbers. It can be close to 50% of GDP, the one that is in the informal sector. So there is a big challenge there. The other is the issue of drugs. I think that can take not only whole afternoon, but a whole set of dates, especially in the relationship between Mexico and the U.S. economy. I think there the main aspect, the most negative aspect is violence. And I think that certainly has costed Mexico at least close to 1% of GDP of growth, just the aspect of violence. And that is something where the Mexican government is addressing, but we know from the beginning that it's not something that can be fixed from one day to the other. It will take probably 5 to 10 years. We can think that we have 6, 7 years on this, so there might be 3 or 4 more years before we see a much better scenario. The Mexican government is persisting on it, but also more cooperation from the U.S. government would be more than welcome, no? So I think that the aspect of having a much better legal regime in Mexico is important, and that's a part of that's a structural reform we need to take, and if we do that, it certainly would help Mexico in a very important way.
Michael?
You raised the prospect of an Amero. I was involved in some of those discussions. We can talk about that later. But in Bob Mundel's original work on optimum currency areas, Bob being a Canadian, he made the point that a more natural currency union might be between Western Canada and the Western United States than between the U.S., the west and east of the U.S. to the west and east of Canada, because of natural trade flows. Yes. And migration and labor mobility, which obviously is an issue for Canada. So I don't know if Bob was one of your professors back at Chicago, but I don't know if you care to make a comment about the generic issue of optimum currency areas and what any of that might mean for Europe. That is, they put together now 17 countries in the Euro, and with very different characteristics, very different migration flows, and all these other things. So I'm just wondering if you thought some about the generic issue, even if I would tend to agree with you, given it was going to be, with the currencies were going to remain with the nations, that an Amero was a bad idea. Just whether you've thought some about that and whether it had any application to what Europe might do going forward.
Well, I think in some areas of Europe, I think you can make a similar case. But I think I mean, the bottom line of Europe is that if you discuss this, have a debate like the one, or you present the arguments like the ones I present today to any central banker, they would, I would say, intellectually recognize the limitation of it. But what in a way is inspiring, and that's what keeps them going, is a much higher pursuit or a much higher objective, and is to use economic integration and a common currency as a vehicle for peace. And I think I mean, once you get to that level, there is nothing to discuss, no? And so at the end of the day, they might say, well, you know, you might be right, it's not, the fundamentals are not there, but you know, if it helps us avoid the Third World War, we'll go for it. And that's why even today, under very difficult situations, I'm facing very dramatic choices, for example, of how the fiscally where the discussion will go. Will you subject your fiscal deficit, your tax treatment, to the scrutiny of a European Commission? I mean, that's very, very tough. So my own sense is that the Eurozone is more a political experiment than a real economic experiment. And that's why at the end of the day, it's more argued and sustained idea by a political conception of Europe.
We have time for one more.
You mentioned reform, the structural reforms in Mexico is an important part of the convergence that you were talking about, and I think you would agree one of the most important ones of those is the fiscal reform. Recently, there's been criticism, particularly from the right, that current fiscal reform will only extract more resources from the few Mexicans that are already paying taxes instead of try to extend to all this informal sector or other people who are not paying the appropriate amount of taxes. What's your take on the current fiscal reform proposal?
Well, first of all, it's an adequate reform. I mean, it addresses many distortions that were present. In terms of value-added tax, it homogenizes the value-added tax at the country level. It reduces or eliminates some loopholes in the income tax law. I mean, we could have thought, and many of us might have thought of a different type of reform. But I think that in most of the cases, it's an adequate reform. You have also the advantage on fiscal issues that each year you come back to Congress. So, I mean, we're a country that at least have a budget every year, and that gives us an opportunity to remedy any distortions we might have. I mean, there was a very famous Minister of Finance in Mexico that used to say that the best fiscal reform is the one that is possible. And having been a Minister of Finance, I think that that's the case. And I would say that the U.S. Treasury Secretary would also say the same.
Great. Well, thank you very much for getting us off to a great start. This was fantastic.
Thank you.